Hello everyone, I'm Russ
I'm Giles.
and we are the Morrison Mortgage team. This is a quick update for you on the Bank of Canada's decision today, which is they have increased the prime rate once again by 50 basis points, 0.5%. It's now up to 6.45%. So to put that into perspective is since March of this year, the prime rate has gone from 2.45% up to 6.45%. And that's quite a hike in a short period of time. Giles, what's the at this point in time? What's the consensus? What's the feeling from the latest, like today's announcement? You know, what are the economists saying? What's the general feeling we're getting from them now?
Yeah, so generally this announcement, the rate increases were what was predicted. Across the market, it was predicted either 0.25 or 0.5, so this was expected, this increase. The interesting thing people were waiting for today was, okay, after this increase, what are the Bank of Canada going to say? What are the statements going to be like? And what they were today is they were saying we will monitor inflation to see if we need to make any further changes, whereas all of the statements before have said we will be having to raise rates more. So I think the key thing is, and the general feeling as well based on this feedback, is that we may be nearing or at the point where they aren't committing to further increases, so this may be the peak, or they are leaving things open to either go up or go down, which is a departure from the kind of statements they have been saying throughout most of this rate hike.
Exactly. It seems like it's less hawkish and less aggressive in their statements. So the next Bank of Canada meeting date is the end of January. So that should give us two inflation, basically monthly inflation feedback to see how inflation is responding to these rate hikes. Okay, if you have any questions on it, always feel free to reach out to us. Okay, so how does this increase our payments?
Yeah, so the announcement today affects people in variable rate mortgages, and as we covered before, if you're in a variable rate mortgage where your payments change, your payments will increase after today's announcement. If you're in a variable rate mortgage where your payments stay the same, the amortization will increase, which means that the portion of interest, the amount of interest owed with each payment will increase as well. And there are potential, for those people where your payments don't change, there are potential trigger rate and trigger point implications. So we have discussed that before as well. So do reach out if you have any of those concerns as well.
Yes, if you get any messages from your letter, feel free to reach out and ask us any questions on the trigger rate and trigger point and that sort of thing. Okay, so refinancing now. I know that we have been fielding some calls from clients mentioning that, of course, a 4% increase has been a bit challenging for all of us, to be honest with you, and I have had some people reach out to say that their monthly expenses and that sort of thing are becoming more challenging every month. If you are having some challenges with that, please feel free to reach out. We can see what we can do to help you with that. Refinancing is one option that you may have in order to lower your payments, take care of any high interest debt like lines of credit, auto loans, or unsecured lines of credit, because those would have all gone up with the prime rate as well. And also for any situation that will happen now that it seems like the property values are dropping a little bit as well, is that we are seeing some investors step out into the market to look at buying real estate because they feel like things are getting kind of to the bottom now because we're almost at the peak of the rate increases. So if any of these things resonate with you, need any assistance or any advice on that, please let us know, reach out to us, and we can run through a strategy session with you. Okay, so for those of you that are having your mortgage come up for renewal, let's talk about that. Giles, just some things that we've talked about on renewals and stuff, and how can we prepare and give advice to people? What advice would we give them at this point if they're coming up for renewal in the next year or so?
Yeah, so the key thing to bear in mind is if you are coming up to renewal, there may be a what we call a payment shock. So the rates are likely to be higher than the rate that you have right now. So if you secured your mortgage, it would be close to 5 years ago, the rates now will be somewhere in the sort of 5 to 6% range, approximately. It may be slightly different to that. So they may be different to the payments you have currently. Now, if you're coming up to renewal, of course, you would have paid down your mortgage and your amortization will be 5 years less. So there are options at that stage through a refinance to spread those payments over longer to maybe cushion some of that. But if you do have those concerns coming up to renewal, we do reach out to our clients as well throughout the process to try and discuss these. And you can reach out, even if it's sort of 6 months, a year or so in advance, and we can run through what some of that would look like, with your current rate versus the rates that you'll be able to secure upon renewal potentially.
Yeah, I think now more than ever, preparing for that, taking a fixed or a variable upon renewal is strategizing on that is now more important than it ever has been. And if you're having any challenges and your mortgage is coming up for renewal, it doesn't mean we have to wait until your renewal comes up in order to make changes. We can look at things before that as well. So please reach out and we can run through a strategy session and kind of look at the before and after and give you advice on that. So is it a good time to buy a property? Now, this has come up a few times with our clients as well, and we are seeing more people that we've had in the pre-approval category begin to step out and contact us because they want to get in the market. Now, some of the challenges that we're having with those are, everyone is looking okay at this point, but qualifying, say at the beginning of this year, you'd qualified a stress test rate of 5.25. We're now sitting around 8%. Any other challenges and thoughts? The market has changed. It has shifted, Giles. What are we seeing a bit on that? Tell us a bit about what we're kind of seeing on that.
Yeah, so market-wise, it is definitely, and from realtors we're in touch with, feeling a lot more balanced right now. It's not the market where you're having to in all cases, this is location dependent as well, but where there's multiple offers, you're having to do things like subject free offers and things like that, where you wouldn't be comfortable in order just to secure a property. There's not the, frenzy that there was previously. So it is a bit more balanced. It is a bit more, sensible. Could be a word to describe as well. So it is better than it would have been earlier on. The counter side of that is of course qualifying has been affected. So as Russ mentioned, the impact of this is a very approximate calculation is previously, whereas you may be able to qualify for 5 to 6 times annual income, now it's closer to 4 times annual income. So that's the difference there. People can afford slightly less, but it means there potentially will be lower competition. And I think the key thing is, with real estate, if you take the long-term view, then having less competition and investing for the long term is still a good idea, as long as you're kind of taking that long-term view rather than trying to speculate over sort of 6 months, a year or so, or something like that.
Absolutely, and like the idea, like the forecast on rates now is we're anticipating that we are at the top right now, and seeing where the property values will go in the coming months, that will determine, we've got the rates going up and the property values coming down, and then as soon as we hit that ceiling on rates, and eventually the forecast is for the rates to begin to come down at the end of next year, then we will likely see the property values begin to move up or spike up again once we see a flurry of activity. So that's what I think. I think we're sitting in spring. We have some more activity, and as we get later, into the year, expecting rate decreases in that, then we'll see more activity come. So there is going to be a sweet spot next year that where there's less competition, less multiple offers, and more of a balanced market to look at. Okay, so fixed versus variable. All right, we get this question all the time. So quick thoughts on that. Let us know what you think, and then I'll add to that as well. So what do you think, fixed or variable, Giles?
Yeah, so I think depending on your circumstances, but if somebody's in a variable rate, if they're worried the variable has increased, should I lock into a fixed? So generally the advice in this case would be, if you can, hold the course with the variable. If there's still enough time in the duration of your term as well, if you have kind of 2-3 years plus, there will be time for that variable rate to come back down. So locking into the fixed right now would effectively be locking in at near where the peak is going to be. The only exception to that now is the fixed rates have come down slightly. So if somebody's in a variable that's now around the 6% range, depending on circumstances, there may now be fixed that are slightly lower. But again, you'd be locking into that for the next potentially 5 years, whereas in the variables come down below that. I think the general advice is locking into a fix that has its own risks, because you'd then be locked in at the high levels we're at currently.
The penalties as well are significantly higher. So if we sit at, say, the fixed and the variable are, say, roughly about the same right now, when the prime rate begins to come down, your variable will come down, but your fixed will stay. And if you want to come out of that fixed rate, the penalties can be very, very large. So we're anticipating, what we're doing personally is we're staying variable, because we do feel, and we to go on a limb, is the rates will come back down. They will, but it's just a matter of time. And that, so that's what we're recommending is still to, depending on your situation, like Giles had mentioned, is the variable is still looking good, because the anticipation of those rates coming down. So That is it for this update. Thank you for watching, and if you need anything, please reach out. That's what we're here for. And have a great day, and happy holidays to everyone, and Merry Christmas to all of you as well. Take care. Bye.